Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to Fundamentals, our regular look at the world of funds and collectives, where we highlight one of the most popular purchases on the AJ Bell Invest Centre platform, and then analyse why advisors and clients might be buying right now. So this week, third on the list for passively run funds is iShares Core S&P 500 ETF or Exchange Traded Fund. An ETF is designed to track, mirror the performance of the underlying assets and deliver that performance minus the running costs. This means this particular tracker is following one of the US stock market's best known and broadest indices. iShares Core S&P 500 uses physical or direct replication to generate performance, so it owns the underlying securities, which in this case, some of America's biggest and best known firms, Apple, Microsoft, oil giant ExxonMobil, healthcare specialist Johnson & Johnson, and industrial conglomerate General Electric, well, they're the top 5. The tracker comes with an ongoing charge figure of just 0.07%, so it's very cost effective. According to data from Morningstar, only 2 trackers from ETF provider Source are cheaper out of a field of 80. The iShares product is huge as well, with over $12 billion in assets under administration or management, so it should be pretty liquid, at least under normal market conditions. It's SIPP and ISA eligible, and this particular instrument comes with accumulation units, so any client buying this particular version will have dividends reinvested rather than distributed as cash. Now the ETF is nearly 6 years old and comes with a 5-star ranking from Morningstar for those who place importance in such things. As a final point, the ETF comes with dollar or sterling priced options. This chart shows the performance of the sterling version since launch. As you can see, it sticks to the index like glue. So that's the mechanics out of the way. The question now is, why would advisors and clients be buying today? Well, I think there are 3 possible reasons. First, the US economy might not be tearing up trees, but it's doing better than most of its international counterparts. Japanese GDP shrunk year on year in 3 of the last 5 quarters. The UK's growth has decelerated 4 times in a row, and Europe looks to be stalling again. By contrast, the influential Atlanta Fed's GDP Now survey expects 2.2% year-on-year GDP growth for the US in Q1, an acceleration from Q4. A string of decent enough macro numbers have also calmed fears that the US is heading for a fresh recession, although nothing can be taken for granted. Further improvement in the influential sentiment surveys, or purchasing managers' indices, really is needed, and it would be helpful to see the monthly manufacturing PMI go higher, given the historic relationship between that indicator and the S&P 500 index. Secondly, the Brexit referendum set for June may be persuading some clients to simply park their cash overseas, just in case sterling takes a drubbing. The pound's already dropped from $1.57 to $1.42, so this increases the value of dollar assets once they're translated back into pounds, assuming of course the price of the securities doesn't fall even faster. This chart here shows the sterling dollar cross rate. And thirdly and finally, for everything that's been thrown at it, the US market's been remarkably resilient. At just over the 2,000 mark as I sit here, the S&P 500 is down by only 5% from last year's all-time high. The FTSE 100 is down by nearly 12%, Japan by nearly 20%. In addition, volatility seems to have calmed. More US stocks have set 52-week highs and 52-week lows for the past fortnight or so, and that's a good sign, certainly when compared to January's low, when you had just 3 highs and nearly 1,400 lows. So there's a little bit more depth to the market, though you would like to see highs outstripping lows by a couple of hundred or more really, as they were at this time last year, to give you real confidence we're over the winter wobbles. This final chart shows the gap between new 52-week highs and lows on the New York Stock Exchange, and then runs that gap against the S&P 500. Let's see how those trends develop. Thank you for watching, and I look forward to seeing you next time.